Welcome, everyone. Today, we will explore Chapter 2, which focuses on cost accounting methods and techniques. I'm excited to guide you through this important topic. In this session, we'll familiarize ourselves with various cost accounting techniques, understand different methods used in cost accounting, and get an overview of the standards and objectives that govern this field. So, let's get started and deepen our understanding of how cost accounting helps in effective management and decision-making. Now let's take a look at the different methods of costing. First, we have job costing, which is used when work is tailored to specific customer requirements. It's ideal for projects or orders that are unique, where costs are tracked for each job separately. Next, we have process costing. This method applies when raw materials pass through a series of processes in a specific sequence until the product is completed. It's commonly used in industries like chemicals, textiles, or food processing, where mass production occurs through continuous processes. Finally, we come to hybrid costing, also known as multiple or composite costing. This approach combines elements of both job and process costing, applying more than one method to the same product. It's useful in complex production environments where different parts of the process require different costing techniques. All these methods fall under the broader category of costing methods, which are essentially the techniques and procedures we use to determine the costs of products or services. Understanding these methods helps us choose the right approach based on the nature of the production or service, ensuring accurate cost measurement and better decision-making. Contract costing is most suited to large-scale projects such as the construction of buildings, dams, bridges, roads, and even shipbuilding. These are typically projects where the scope and complexity are significant. Now let's talk about contract costing itself. It is actually a variation of job costing. The key difference between a job and a contract is size. You can think of a job as a small task, while a contract is a much bigger, more comprehensive undertaking. In fact, it's often said that a contract is just a big job, and a job is a small contract. When we look at the job costing method, it can be further divided based on different industries. For example, it's used in printing presses, repair shops, interior decorators, painters, and similar fields. The main idea of job costing is that it applies when work is undertaken to meet customers' specific requirements. It's a method that helps us track costs precisely for each unique job or project, especially when those jobs have particular specifications. So, in summary, contract costing is essential for large, complex projects, and job costing, especially in customized work, allows businesses to accurately allocate costs to each individual job, ensuring better control and profitability. This method is primarily used in companies that manufacture ready-made garments, toys, shoes, tires, and tubes, as well as various component parts. It's particularly useful when dealing with large quantities of similar products. Now, moving on to batch costing, which is closely related to contract costing. Like job costing, this is a type of specific costing method. But here, the key difference. In batch costing, we determine the cost of a batch or group of identical products, rather than individual items. This approach helps companies efficiently allocate costs when producing in bulk, especially when products are uniform. It's all about grouping similar units together to get an accurate overall cost, which then aids in pricing and profitability analysis. This technique ties into the overall theme of cost management by providing a clear picture of expenses for large production runs. Let's now look at single, output, or unit costing. This method of cost ascertainment is particularly useful when production involves a uniform process, and the products are quite similar, often just 1, 2, or 3 varieties of the same product. For example, you'll find this method used in industries like textile mills, chemical works, sugar mills, refineries, and soap manufacturing. The idea is that since the production process is consistent and the products are similar, we can easily determine the cost per unit without much complication. Now, moving on to process costing. This method is applied when raw materials go through several processes in a specific sequence until they reach the final stage. Think of it as passing through multiple checkpoints or stages, where each step adds value or transforms the raw material. This method helps in accurately assigning costs at each stage, giving us a clear picture of production expenses from start to finish. Both methods are essential parts of cost accounting, helping us understand how costs are accumulated and allocated in different types of manufacturing setups. They tie into the overall theme of cost control and efficiency, key elements for managing production effectively. Now let's look at some examples of transport undertakings, such as road transport, railways, airways, and shipping companies. You'll also find electricity companies, hotels, hospitals, cinemas, and similar service providers falling into this category. Next, I want to clarify the concept of operating or service costing. It's important not to confuse this with operation costing. Operating costing is specifically used in industries that provide services rather than manufacturing products. For example, industries like air conditioners, refrigerators, scooters, cars, and locomotive works all utilize this method because their primary output is a service or a finished product that involves service aspects. Finally, let's discuss multiple or composite costing, which is also known as hybrid costing. This method involves applying more than one costing technique to the same product. It's particularly useful when a product or service has multiple components or stages that require different costing approaches. By combining methods, we can get a more accurate picture of the total cost, which helps in better decision-making and pricing strategies. So, in essence, these various costing methods are tailored to different industries and their unique requirements, helping businesses better understand their costs and improve their efficiency. Now, let's talk about departmental costing. Essentially, a factory can be divided into several departments, which helps us manage and analyze costs more effectively. Sometimes, by allocating expenses initially to these departments, we can then further assign costs to the specific products made within each department. This two-step process often leads to better accuracy in estimating and distributing expenses. As we'll see later in the presentation, departmental costing is generally quite advantageous because it provides a clearer picture of where costs are incurred, making it easier to control and make informed decisions. It's a practical approach that aligns well with the overall goal of understanding and managing costs more precisely. Let's take a closer look at example 1. Here, we want to understand how applying the key concepts we've discussed can make a real difference. This example highlights the practical application of the strategies, showing how they work in a real-world scenario. By examining this example, you can see how the principles come together in action, reinforcing the importance of the approach. It also demonstrates the potential outcomes when these ideas are implemented effectively. Remember, each example we review is meant to connect the dots between theory and practice, helping us see the bigger picture and how these concepts can be adapted to various situations. So, as we walk through this example, keep in mind how the core ideas we've explored so far come into play here. Let's walk through the problem for Job 123. First, we have the data on direct materials issued on 3 different dates. OMR 1200 on July 14, OMR 650 on July 20, and OMR 350 on July 25, which totals OMR 2200. Next, for direct labor, there are hours worked during 2 weeks. 180 hours at OMR 6.5 per hour in the week of July 20, and 140 hours at OMR 7.25 per hour in the week of July 26. To find the total direct labor cost, we multiply hours by the respective hourly rates. That gives us 180 hours times OMR 6.5 and 140 hours times OMR 7.25. Now, factory overhead is applied at OMR 4.5 per direct labor hour. So, we need to calculate the total labor hours, which is 180 plus 140 hours, totaling 320 hours. Multiplying 320 hours by OMR 4.5 gives us the total factory overhead applied. Adding up all these costs, direct materials, direct labor, and factory overhead, gives us the total cost of job 123. Finally, to determine the sales price, we add a 40% markup on the cost. So, we multiply the total cost by 1.4 to get the contracted sales price. This process illustrates how job order costing helps us assign and accumulate costs specific to each job, which is essential for accurate pricing and profitability analysis. Let's look at problem 2 first. We are asked to prepare process accounts based on the given data. For process A, we have materials worth RO 1,500, labor costing RO 800, and other expenses of RO 220. For process B, the materials are RO 500, labor RO 2,000, and other expenses RO 708. The total input introduced into the process is 200 units. Additionally, there are indirect expenses totaling RO 850, which we need to apportion based on wages. That means we'll allocate these expenses proportionally to processes according to their wage costs. This helps us get a clear picture of the true cost incurred by each process. Now, moving on to problem 3, we have process X and process Y. The materials cost RO 10,000 for X, and RO 15,000 for Y. Labor costs are RO 5,000 and RO 7,000 respectively, with other expenses at RO 2,500 for X and RO 4,000 for Y. The total input introduced is 500 units. In this case, the indirect expenses of RO 15,000 are to be apportioned based on other expenses. So, we'll allocate these expenses proportionally according to the other expenses incurred by each process, which helps us understand the complete cost structure. Overall, process costing allows us to determine the cost per unit by accumulating all costs associated with each process, including materials, labor, and allocated overheads. Properly apportioned expenses ensure accuracy in cost calculation, enabling better pricing, controlling costs, and analyzing profitability across different processes. Now, let's look at how we analyze the difference between standard and actual costs. The main purpose here is to understand why these differences occur so we can take corrective actions accordingly. This technique involves setting a standard cost beforehand, which acts as a performance target. Then, we measure the actual performance against this standard to see where deviations happen. Standard costing is a very valuable control tool because it helps us compare expected costs with real costs and identify areas that need attention. It's important to note that these techniques can be used for specific control purposes or to shape company policies, regardless of the costing method we are using. Overall, these techniques of costing are essential for maintaining cost control and ensuring the business runs efficiently, aligning actual performance with our strategic goals. This is so because marginal costing regards only variable costs as the cost of the products. Fixed cost is treated as a period cost. It is transferred to the costing profit and loss account of the period. Now, moving on to marginal costing itself. This technique focuses on separating costs into fixed and variable, which is of special interest and importance. This separation allows us to use marginal costing not just for planning, but also for control and coordination of business operations. A budget, in this context, is essentially a financial expression of a firm's plan. It helps us project how much we intend to spend and earn over a period. Budgetary control is a technique closely related to standard costing. It involves comparing actual performance with our planned performance to keep our operations on track. By doing this, we can effectively control total expenditure on materials, wages, and overheads, ensuring that we stay within our financial plan. So, in summary, both marginal costing and budgetary control are vital tools. They help us make informed decisions, optimize resources, and maintain control over our financial performance. Let's take a moment to understand how comparing the performance of one firm with others can be really beneficial. When we do this, we can learn from the best practices and better experiences of different companies, which can help improve our own performance. It's like having a benchmark to strive for. Now, moving on to uniform costing. This simply means that a group of firms adopts the same set of costing principles. It's not about a new technique or method like standard costing or process costing, but rather about standardizing the approach across multiple firms to make comparison easier and more meaningful. So why is this important? Well, uniform costing helps in maintaining consistency in how costs are calculated and reported. It allows us to compare apples to apples, so to speak, making it easier to analyze performance across different firms in the same industry or sector. And finally, let's touch on total absorption costing. This is a traditional method where we assign all costs, both fixed and variable, to the products. Essentially, it means that every cost incurred in production is absorbed into the cost of the product. This approach gives us a comprehensive view of the total cost involved in manufacturing, which is crucial for pricing and profitability analysis. Together, these concepts, performance comparison, uniform costing, and total absorption costing, are fundamental to understanding how firms manage and analyze their costs effectively within the overall framework of cost accounting. Though organizations adopting some cost-related standards through IFRS is quite common, in Oman, it's actually optional for organizations to apply these standards, depending on their management's needs. Many other countries haven't yet adopted these standards at all, which shows how varied the global landscape is. Some countries have taken a different approach. They've adopted certain standards and made them mandatory for specific departments or processes within organizations. Now, when we talk about cost accounting standards, or CAS as they're popularly known, we're referring to a set of standards and rules issued by government authorities. These standards are essential because they help determine costs accurately for government and business organizations alike. So, in summary, while IFRS-related standards are gaining traction, the adoption of CAS varies widely around the world, highlighting the importance of these standards in ensuring consistent and transparent cost measurement across different entities and sectors. The objectives outlined here are really about creating a clear and consistent framework for cost accounting. First, we aim to provide guidelines that help establish a standard approach to maintaining cost accounting records, especially considering the different statutes that may apply. This ensures uniformity and compliance across various industries and organizations. Second, we want to assist cost accountants in preparing uniform cost statements. This is crucial because it promotes comparability and accuracy, making it easier to analyze and interpret cost data. And finally, we're focused on offering better guidelines for standard cost accounting practices. This helps in setting benchmarks and ensuring that cost management is both effective and reliable. All of these objectives tie into the overall goal of the CAS, which is to bring clarity, consistency, and professionalism to cost accounting processes. It's about making sure everyone is on the same page and working with the best practices to drive better decision-making and compliance. Now, let's take a closer look at some different costing methods. First up is batch costing. Batch costing is a bit of a variation on job costing, where instead of costing individual jobs, we focus on each batch of production. This is especially useful when items are manufactured in definite batches, making it easier to calculate the total cost for that batch. Next, we have budgetary control. This is a system that helps organizations keep their actual revenues and expenditures in line with their financial plans. Essentially, it's about setting budgets and then making sure the actual financial performance adheres closely to those plans, helping with effective financial management. Moving on to contract costing. This method is all about tracking the costs associated with a specific contract with a customer. Whether it's a construction project or a bespoke service, contract costing helps ensure we know exactly what each contract costs us. Then there's departmental costing. This approach estimates the cost of output for each department separately, which is particularly handy when manufacturing standardized products across different departments. It allows us to see how each part of the process contributes to the overall cost. Now, hybrid costing combines features of both job costing and process costing. It's a flexible system that can adapt to various production settings, capturing the benefits of both methods depending on the nature of the product or service. We also have job order costing. This method accumulates costs for individual jobs or lots. A job might be repairing equipment, providing a service, or even treating a patient in a hospital. It's all about tracking costs at the job level to ensure accurate cost control and pricing. Finally, process costing. This system first gathers costs by processes. Think of it as breaking down production into stages. Then, it allocates the total costs of each process evenly across each unit of output during a specific period. It's ideal for continuous production environments like chemicals or textiles. Each of these methods plays a vital role in how we manage and control costs, helping us align our financial strategies with operational realities. Now, as we wrap up, let's briefly touch on how we account for materials costs. This is a key part of our overall cost management because accurate tracking ensures we understand the true cost of production. When we record materials costs, we need to consider whether we're tracking raw materials, work in progress, or finished goods. It's important to stay consistent in our methods to avoid discrepancies. Also, recognizing the timing of costs, whether they're incurred at purchase, during production, or at sale affects our financial statements and decision-making. Remember, proper accounting for these costs not only provides clarity for internal management, but also ensures compliance with financial reporting standards. This ties back to our broader theme of maintaining transparency and accuracy in our financial processes.